Welcome to episode 84 of the Cashflow Connections podcast. The topic for today is Gerald Celente's predictions on trade wars, stocks, real estate, and gold. Pretty much everyone that knows anything about predicting markets knows that it's very challenging to anticipate what the next black swan event will be. The reason for this is that there are just too many potential challenges in the economy which could cause a recession. Also, because of the division of labor, most people are only focused on one sector of the economy. So, for example, when the housing market was going completely parabolic in 2005 and 2006, if you worked in the restaurant industry, you wouldn't have had a really good understanding as to how crazy the housing market really had gone. You might know that prices were increasing, but you wouldn't have a reference for how out of whack things really were. It is just outside of your area of expertise. And this is one of the reasons that I like to keep a very broad approach to this show. The more data you have access to, the better protected you are to the downside. And this interview is really a great example of that. So in this discussion, we have someone who has made a career out of identifying and predicting trends which will shape the landscape of our economy and the investment sector. These are trends which are not specific to one particular sector, but truly the global economy and the global capital markets. And we're going to talk about a lot of different topics today. So we're going to talk about the trade war, what's going on with China, and what are the implications of the so-called trade war. What are some of the potential black swans our guest is keeping an eye on, and what could they mean for the economy if they were to take place? Also, if we are going to have a significant correction, what type of correction will it be? Will it be a 1987 style correction, a 1929 crash in the stock market, or will the U.S. enter a decade or multi-decade period of low or negative GDP growth? All of this is covered and more. All right. So I was actually doing some digging around in my closet last week looking for something, and I found that I still have several Cashflow Connections tumbler-style coffee cups, and I'd really love to send one to you. So as you may remember, we're doing a podcast initiative to create an ad for the program. So if you've enjoyed the show, send me a quick voice memo to info@cashflowconnections.com. You can just search voice memo in your iPhone and just record something quick and send it to me. Basically, just say something like, "Hey, Hunter, love the program, learned a lot, gave me the confidence to invest in deal more frequently," or maybe you can say, "You said something on the program that made me pass on a deal," or maybe you just don't really care about the content, but you just like listening to something driving to work. Whatever your story is, record a short 30-second or less voice memo, shoot it over to info@cashflowconnections.com, and be sure to include your mailing address, and I'll send you one of these awesome tumbler-style coffee cups. These things are awesome. I'm actually looking at mine right now. It's always on my desk when I'm working. They have a top on them, so they're great for traveling. So go ahead and do that, and I hope you enjoy the episode. How's it going, everyone? Our guest for today is Gerald Celente, who is the publisher of the Trends Journal. He has earned the reputation as today's most trusted name in trends due to his consistent accuracy in identifying upcoming changes, as well as his timely forecasts since 1980 regarding global financial markets and other important events. Honestly, that brief introduction does not even do us justice. We'll get into a ton of awesome stuff today. Gerald, thanks again for coming on.
Thank you, Hunter.
Yeah, I'm really interested in your background because I know that you have a lot of interesting perspectives. But before we even get into your predictions, your trends, what you think is going to happen in 2019, 2020, and beyond, I want to hear more about what you were doing prior to and then how you got introduced to financial markets. When did you start being drawn to things like this and predicting changes, et cetera?
Well, what happened was at a graduate school, I was the number 2 guy running the mayoral campaign in Yonkers, New York, which is a sizable city, but at that time was just under 300,000 people. And I worked on political campaigns in Westchester County, which at that time was the richest county in America. And then they sent me up to Albany. They were grooming me, and I was the assistant to the secretary of the New York State Senate, designed and instructed American politics and campaign technology, and taught at St. John's University. And then I was the chief government affairs specialist for the chemical industry, a big sector of the chemical industry back in the 70s. I have a photograph of me and Ronald Reagan in 1976. I was with him for about an hour and a half. He was speaking to our group, and I was in charge of the whole thing. And it's 2 days before he's announcing that he's running against Jerry Ford. And so it was a big media event as well. And then what happened is that I was living between D.C. and Chicago at the time. And in the 70s, the Iranian conflict started to break out. And I had become interested in gold because the inflation rate under Carter and the madness of his, it was people were leaving the cabinet left and right. It was stagflation. I remember as a young guy getting like a 10% salary increase just to keep up with inflation. And so I became interested in gold. But my first buy of gold was $178.50 an ounce. And I started buying gold like crazy. I parlayed a $5,000 bet. And in those days, it was hard to play the futures market. Nobody knew what was going on in that field. So, and I'm a young guy. I don't know what I'm doing. And I parlayed it into almost $750,000. Make a very long story short, I lost most of it, kept gambling.
Wow.
But anyway, what happened was that what got me into the field is I became a political atheist. I'd been around, I'm at 28 years old. I'm putting my meetings on at the Hay Adams, and I'm staying at the Willard Hotel. And I was really good at what I was doing. And Jimmy Carter goes to Iran, and the Iranian conflict is starting to break out. And I've been following it for years. I just had a very keen interest in history throughout my life. And I knew how the United States overthrew the democratically elected government of Mossadegh in Iran in 1953. You have the CIA, the MI6. And by the way, all that information came out in 2017, June, with the going back and forth between the CIA and the MI6, but it never made the American news media. Winston Churchill actually used the words, "We need their energy," meaning Iran's. And that was, then those days, it was Anglo-Iranian oil, better known today as BP, and Standard Oil, better known today as ExxonMobil. And Kermit Roosevelt, Theodore Roosevelt's grandson, was the CIA guy that staged the coup after the first one failed. So anyway, I knew the history of this thing and how brutal Savak, the secret police, was. I mean, they were a perfect match for the SS. And you'd read these stories on and on. So anyway, when the riots started breaking out, and I saw millions of people taking to the streets, I said, this thing is real. And again, I'd been around a long time, enough at the time. In the Bronx, we used to say, BS has its own sound, And Jimmy Carter comes back from spending New Year's Eve with the Shah and his wife, him and Rosalind. And he announces to the American people that the Shah was the island of stability in the Middle East. And what a bunch of crap this is. I said, as we said in the Bronx, BS has its own language. And that's all that was. It was a lot of crap. I said, this thing's going down. And that's when I started investing heavily in gold and oil futures. And I became a political atheist at that point. I watched how the whole American society bought the BS line being fed to them. And how everybody bows down, sucks up, and follows the leader. And that was the beginning of my career, and I quit shortly after that. I quit my job. I was killing environmental legislation back in the day. I worked for as I said, a sector of the chemical industry, and I started growing up, and said, I can't do this anymore. And I saw what I was doing. I was antimicrobials, that kind of stuff was, I was working on. So that's how I became attuned to the economic landscape and the fraud behind so much of it. And then made my name as a trend forecaster in 1987. And in those days, you used to send out press releases. This is long before the internet. And we sent out a press release in the beginning of January, like the second week of January of 1987. And then the headline was something to the effect, "This is the year the markets will crash." And then Wall Street Journal picked it up when they did crash in October. And that's how I began, being recognized, my skills as a trend forecaster. And then I wrote Trend Tracking, far better than Megatrends, Time Magazine, and then Trends 2000, other books and the publication. I started the publication in 1991, the Trends Journal.
Wow, that is remarkable. And there's so many things I wanted to get into there. I mean, first of all, just that situation in Iran, going to the oil, and then 1987. One of the reasons I'm excited to talk to you about this is that you've been through so many cycles. You started on the political side of things, working on the economic side of things, but not necessarily the study of economics, but just the real world economics in terms of actually investing. And with someone that's been through a lot of cycles, you have a perspective which is significantly different than someone that, started in 2000, got wiped out in 2008, and now is here to tell the sob story. So I'm looking forward to this conversation. Obviously, this is just the beginning of 2019. There's a million questions people are asking, what the economy's doing, what the stock market's doing. It's obviously a really interesting part of most people's portfolio, and then real estate, of course. So I have a lot of topics that I want to get into, and even if I don't hit them all, I want to circle back to them because I know that we have a lot of stuff to get into today. So let's start with, something that I think you have an interesting perspective on, but also generally speaking, I've had the opportunity to interview a lot of people about the economy and making predictions, and a lot of it always comes down to the Fed. So let's start with that. What are some of your thoughts on what the Fed is doing, where you're anticipating interest rates going, how significantly you will anticipate the Fed's actions really having on the economy overall?
We were the first to call the Trump market rally in the Trends Journal in November of 2016, 2 weeks after he got elected. He said he was going to lower taxes, deregulate, and infrastructure improvement. He did two of them, not the third. The tax breaks, when that started to happen as well, again, I've been around a while. I knew what happened when George Bush Jr. did them. I think it's 2005, 2006. Some 95% of the tax breaks for the big corporations and repatriation of money overseas went into stock buybacks. So we knew that the rally would continue. In February of 2018, we said it was the end of the Trump rally. And that was because the Fed was aggressively raising interest rates. Some people call me a futurist. And I always said, I'm not a futurist. Nobody could predict the future. There are too many wild cards. I coined the term Panic of '08. I took out the domain name in 2017. I thought we'd go into a depression by 2012. I was 100% wrong. Because in Economics 101 and in graduate school, they didn't teach me about zero and negative interest rate policy or a scam called quantitative easing.
Mm-hmm.
So I was wrong about that. And so now going back, what I learned is that, there's always the wild cards. That's why you can't predict the future. So going back to the Fed. In September of 2018, we issued a trend alert to our subscribers, warning them of an economic 9/11. We've been saying all throughout 2017, 2018, that basically all this BS about a trade war and tariffs with China is just a lot of nonsense. It adds up to nothing. If this year they put in all of the Trump proposed tariffs on China, it will affect 0.6% of their GDP. Nothing. So what we're saying has nothing to do with that. It has to do with cheap money, monetary methadone. That's the only thing that pumped the markets up around the globe. So going back to our forecast, September 19th, we made the forecast. September 20th, remember, September 19th, 2018, we forecast an economic 9/11. The markets peaked. The S&P 500 peaked on September 20th, the next day. And then it went down from there. Because the Fed had indicated aggressive interest rate hikes throughout 2019. The numbers that they were coming up were between 3 and 4. Now let's go back and see what happened around November. You started seeing real estate, new mortgage applications, refinancing, way down. You're looking at numbers coming out of Southern California. Home sales plunged 20% to their lowest pace in 11 years. The market couldn't take 5% 30-year mortgage. The whole thing was propped up with cheap money. So now what happens? Well, we had to change our forecast. And the way we changed it was when on January 4th, after the Labor Department comes out with a very, very strong employment number of over 300,000 jobs created, and wages rising for the entire year 2018 to the highest level in 10 years, the Fed chair comes out, Jerome Powell, and says, quote, "We have to be cautious. We're looking at other issues, including market volatility." Market volatility. This is the Federal Reserve. How about the rest of the economy? The rest of the economy is going strong. So you're concerned about market volatility. Hey, did you see that that study that came out, Hunter? 1% of the Americans, that 1% owns 50% of the household shares of all the stocks. Mm-hmm. On average, it's estimated about $350,000, the 90%, and they own on average $350,000. The leftover, the 10% of the people, have only on average $15,000 in equities. So, okay, now you're backtracking from what you said time and time again, how strong the economy was and aggressively raising interest rates. So now let's go back again. Does the President of the United States have any power over the Fed? Does the Prime Minister of India have any power over their central bank? Go back to listen to what Paul Volcker said, the Fed chair under Ronald Reagan, and in his new book that he came out with recently, that he was called to the White House, and James Baker brought them into the library with Reagan, his chief of staff. Reagan didn't say a word, and Baker told Volcker, "The president doesn't want you to raise interest rates before the election." They didn't raise them. What just happened in India? Modi is running for re-election. He got rid of the other central banker, put in a new guy. They just lowered interest rates. So was it the Powell put? Because Trump went after him big time. And then we have in the middle of January, Powell comes out again. And now, not only are they not going to raise interest rates, then it became 2 or 3 times in December after the Fed meeting, after they raised them for the 4th time in 2018. Now we're going to be very cautious. There's no rush to raise interest rates. We are forecasting they're going to lower interest rates. You can see interest rates go back to 2012 levels. You could start seeing mortgages. I bought the 1763 Dr. Jensen house. I own 3 buildings on the most historic 4 corners in America, the only place with pre-Revolutionary War stone buildings. I bought them all in 2012 at the bottom, and I only did it out of passion. I'm not a real estate guy. But that mortgage that I got, a 15-year mortgage, 2.85%. That's what you're going to see again. They are not going to let the economy fail for higher interest rates. So they're going to keep lowering interest rates, and I expect they're going to lower them again this year because you're going to start seeing weakness in the equity markets concerning earnings. Because let's go back again. Over $1 trillion of Trump's tax cuts went into stock buybacks, according to Goldman Sachs, in 2018. And then you had the M&A activity. So now you're going to see earnings levels fall pretty dramatically. Remember, in the first couple of quarters in 2018, you were looking at earnings like 25% up, 24% up. You're going to still see growth in earnings, but nothing like that before. And then you couple it with the global slowdown going on, worldwide, more cheap money.
All right. Well, interesting. I mean, that's probably good news for real estate investors, but probably daunting news for people that are making a bet on the U.S. economy, particularly that are invested in stocks. So we'll definitely see how that plays out. I'm interested, especially given the way that there's been a lot of talk of raising rates and now to anticipate lower rates. I think it's definitely interesting and not with the trend that most people are following, not with the herd. One of the ways to look at the economy, predict the economy, at least a really important fundamental way to understand where we actually are, is looking at commodities. And I want to hear your perspective on, number one, why that is. Number two, what are you seeing in the commodity sector, and what does that tell you about where we're headed?
Well, one of the ones to watch is copper. And in the business, we call it Dr. Copper, because copper is used from everything to heavy industry to high tech. And China buys about 50% of the world's copper produced each year. So that's the one to really look at. And copper has moved back up a bit, but it's still way down below its June 2018 level. It's not quite in bear territory, but close to it. So that's really the one to watch to us. And on the other level, of course, gold, because gold is the ultimate safe haven. And now you're looking at gold in 2018. The central banks of the world bought more gold in 2018 than they have in 50 years. So those are the two leading ones that we watch very closely.
Okay. And are you currently buying gold now? Are you seeing an opportunity in gold as a major investment opportunity?
We don't give investment advice. We had forecast, as our subscribers know, throughout 2018, we said that the bottom of gold is $1,200 an ounce. We were off by $15. One day it hit $11.85. So that was it. Because it costs about $1,200 an ounce from Peru to South Africa to pull the stuff out of the ground. And they're not going to pull it out if it's going to cost them money to do so. So now we're looking at gold, and it's around the 1310 level. And here's our forecast. This has been going on over 5 years, almost 6 years. Gold has to break over 1450 an ounce. Right now, it can't break over the 1385 level. This is just our forecast, and the motto of the Trends Journal is think for yourself.
Sure.
But again, I've been in this business, the gold thing, as I said, was a young guy many years ago, and been watching it virtually every day since. So we're saying it can't break over the 1385, so that's showing weakness in it. But right now, the range that it's in, we believe, is the range it's going to stay. $50 this way, one way or another. But it has to break over the 1450 mark. When it breaks over 1450 an ounce, we are forecasting it's going to spike to 2000. And that reality to us, the potential of that reality is a reality, because what you're going to see this year are central banks around the world, the quantitative tightening, the QT has ended, and more QE, particularly coming out of Europe. You're looking at Italy's back in a recession. There's barely any growth in the German markets. They're looking at like a 1.3, 1.5% GDP growth in the Eurozone. That's nothing. Look at Japan. They had the last 2 quarters negative growth, and they're risking recession. And this is in spite of negative interest rates.
For decades.
Negative interest rates in Japan and negative interest rates in Europe. Nobody ever made this negative interest rate stuff up. Again, that's why you get it wrong. And I have to tell you one of the things I've gotten wrong in my life, and that is real estate. I used to think as a younger guy that when the markets really plunged, they wouldn't bring in what they invented called a plunge protection team, because they didn't teach you that stuff in school. They didn't show you how the markets are rigged. They'll do anything to keep the markets up. So real estate continues to be one of the most solid long-term investments. And there are a number of reasons for it. And one of the major reasons for it is people need a place to live. Number 2, look at the numbers. Go back 100 years ago. 100 years ago is not ancient history. There were about 1.6 billion people on the planet. 1.6 billion. So think, from the beginning of whenever they invented the beginning of time to about 1916, 1917, there's only 1.6, 1.7 billion people on the planet. We've added 6 billion plus people in 100 years. They need a place to live. So real estate, to me, again, something I had missed in my youth, but I understand better now. You have the cycles. And that's all it is.
That's actually an interesting segue, because I definitely want to compare what we're seeing in real estate versus what we're seeing in the stock market and what your perspective is. I mean, we're seeing a fairly significant pullback. The 2018 gains have basically been wiped away. It is interesting to watch as a bystander. I don't have any exposure to stocks, not in the general stock market. But what are you seeing in terms of the general viability of a less investment in the S&P 500, for example? I mean, looking at something like the price per earnings ratio, and I know that that's not the most accurate way to predict where we are in the cycle, but for a layman, for someone that doesn't invest on a regular basis, when I look at that, I'm seeing, even though there's been a pullback, I wouldn't say that broad sweeping, it's a great time to invest in stocks. And first of all, what's your thoughts on that before I even move on? Because I think that's something that a lot of people are thinking right now.
They're going to do anything to juice the market, and cheap money will keep the market going. Again, the rush of the market, we believe, is over, but it's still going to go. And again, that's why we had to change our economic 9/11 forecast, because all they're doing is they're pushing more monetary methadone into the system. And again, we're forecasting that they're going to cut rates this year, and Trump is in charge. And there's no question about it that the Federal Reserve is really, really pressured by the president. So that's what we see. We see that the markets aren't going to grow as they did in the past, but they're going to do anything they can to keep them alive.
So that's actually an interesting point. So obviously the Fed has stopped buying bonds, at least for quite some time, but that doesn't necessarily paint the whole picture, because the rest of the world is doing it on a massive level. For example, you mentioned Europe. So if they're buying bonds and basically printing money, keeping interest rates low, it makes the United States bonds become more desirable proportionally. And so therefore, that printing that's taking place in the ECB, for example, it does have a massive impact on the global capital markets, which most certainly include the US dollar. And that isn't to say that the US won't be doing the same thing, but it's important to note that just because the US isn't doing it currently, it doesn't make the entire picture of the global capital markets. Is that a fair assessment?
Yes, but again, the ECB pumped in about $3 trillion worth of bond buybacks, corporate bonds too. You see, the fundamentals of the economics don't count anymore. And interestingly enough, the head of the ECB, Mario Draghi, he's former Goldman Sachs manager of the European division, head of the ECB. Mussolini called the merger of state and corporate powers, and Draghi, of course, being a paisano, should know this, fascism. And that's what it is. It's the merger of state and corporate powers. What are you buying? You're buying corporate bonds?
Right.
Too big to fail?
Right.
Too big to fail is anathematic capitalism. That's not capitalism. So what I'm saying is they stopped buying them now. And now he's saying they're going to start buying them again. And the system isn't working. Because, again, you're seeing a global slowdown. China has, $30 trillion, $40 trillion, depending on whose numbers you're looking at, worth of debt. And what are they doing now? They're lowering the reserve requirement ratios of banks so they can loan more money out. They're building more infrastructure. They're trying to keep their economy going. China's greatest fear isn't the United States. They talk about the naval disputes and those islands that China claims, and the United States going into the 12-mile limits. China's greatest fear is its people. There are 1.4 billion of them. They used to have reports on all of the demonstrations going on throughout the year. They cut them out. Yeah, and there were like 40,000. So you have all these people without jobs. You got a lot of problems, and they don't want those problems. So China's going to do what they can to juice the markets. Europe, they're going to do what they can to juice the markets. India, you're already seeing it. And then again, Japan. What does all that mean? It means that their currencies are going to go lower. The only reason the United States currency is so strong is because the other ones are so weak. If their economies were doing better, the dollar would be going down. And so the Fed, putting it all back together, can afford to lower interest rates because you're going to start seeing it happening around the world. All the central banks are connected. It's one big team. It's Davos. It's Bilderberg. It's not conspiracy theories. You look at the numbers. We write about it all the time. When one central bank says one thing, another central bank does the same thing in the opposite direction on cue. It's been going on when you watch it forever. So they're not going to crash the global economy. They're working together to keep pumping it up.
Yeah, and you're especially seeing it with the ECB, Japan, et cetera, with the central banks, especially in the United States, the Bank of Japan, for example, there's no oversight committee. There isn't a bunch of nations that have gotten together to do that. So they have complete capacity to hold interest rates wherever they will, and they've conducted one of the largest experiments in financial history. So looking at that Japan model, comparing it to what you saw, you've been in the business for a long time. You saw what happened in the 1980s. You saw a massive correction that took place, which impacted stocks and real estate. What type of correction are you anticipating, given your perspective? Is it a 1980s style correction or a Japan style, quote, recovery, which is, 30 years of negative interest rates and even negative GDP?
It'll be a 1929 crash, followed by a Great Depression. And this is all a Ponzi scheme. That's all it is. And when you look at the numbers, and again, the 1%, and look what's going on now with the presidential reality show. All these people that are running, there are more Democrats now running for president than any other time in recorded history. And what are they talking about? The inequality of wealth. Mm-hmm. What's going on in France? What are they talking about with the yellow vests? The inequality of wealth. What's going on in Italy with the five-star movement and Lega? Same thing. One country after another. So what's going to happen, you saw with the United States, we have three people, Bezos, Buffett, and Gates, have more money than half the nation combined. You have, according to the Oxfam report, was about 23 or 27 people in the world have more money than half the world's population combined. So maybe Bezos, now that he's going through the divorce, he won't be there.
You can't make the list
You can't
anymore.
count those three. You got to count four now. You got to put his wife in there. But anyway, so when this crash happens, it's going to be huge because the fish rots from the head down. So when this rots from the top, we believe it's going to be a 1920s style market crash, and you could envision yourself living in the 1930s, as you're going to see more nationalism, more protectionism, and more fights for survival. When people lose everything and have nothing left to lose, they lose it. And that's what you're going to start seeing more of. So when this crash happens, it's going to be uncontrollable because it's going to be global. And again, the United States, what do we have? An overnight Fed fund rate of 2.25 to 2.50. So they got room to backtrack. What are they going to do in Europe? More quantitative easing? You can't. You're negative interest rate already. Where are you going to go? Where are you going to go in Japan? You're negative already. Hunter, you're a nice guy. I got a 10-year bond for you, and it's a negative yield. So in 10 years, because you're such a great guy, after you buy the bond, I'm going to pay you back in 10 years with less money than you bought it for. And if this was a show where you could use foul language, you'd tell me to go F myself.
Very well possibility.
Bank of Japan is doing it.
Yeah, it's happening right now all over the world.
And that's what they're doing. So it's a scam right in front of everybody's eyes. It's a scam in front of everybody's eyes. So when this thing falls, again, we changed our forecast. We made the forecast in September when the Fed was aggressive in interest rates. Changed the forecast when they backtracked. Powell bent down, man. You do a Google search of how many times Trump called out the Fed. And again, you just saw it happen in India. Of course, that doesn't make any of the news because, hey, what's Stormy Daniels doing this week? What is some stupid thing that they talk about? The news is totally useless anymore. It's not news. It's just stupidity. And now we're going into the presidential reality show. So you're going to see more and more nonsense being talked about and facts being overlooked.
Yeah, and I mean, to be honest with you, it is a little bit of a scary time. I, similarly to you, consider myself something similar to a political atheist. I'm certainly not active politically, but I'm definitely involved in the conversation as an investor. And it is a scary time to be a capitalist in the United States when you can see that the fact that Trump got elected, as a billionaire, that status was now setting the stage for a massive pendulum swing to take place, where people can complain about the billionaire class and talk about 70% tax marginal rates and stuff like that. It is fascinating to hear people talk about marginal rates that don't have a real concept of what it was like back then. I obviously wasn't doing business back then when there was 70%, 90% marginal rates, but I've talked to people that I have, and I've talked to CPAs that have, and man, if you guys think that that is going to be the route to reduce inequality in the United States, I got to tell you, that's not how it worked back then, and that's certainly not how it's going to work now. So I just wanted to mention that because you mentioned that kind of the political space. It's a fascinating time to be someone who is an entrepreneur and a capitalist in the United States.
And it's very important as a trend forecaster. Again, I'm a political atheist. I've been buying gold forever. Do I want gold prices to go up? Of course I do. But what did I say to you? I gave you the scenario of where it would go rather than my saying, now is the time to buy gold. Anybody that doesn't buy gold, we don't do that. We say it the way it is. So when people call themselves a Republican or a Democrat, a conservative, a liberal, a progressive, whatever they want to label themselves, right wing, left wing, you're putting yourself in a box. And our global nomic perspective of trend forecasting is looking at everything without taking a position on anything. Do I have my own personal preferences? Of course I do. But as a trend forecaster, I leave those behind. That has nothing to do with it, because once you latch on to an agenda, once you want what you believe in rather than what is, then you're going to lose sight of the future. And that's why we look at things for the way they are, not the way we want them to be. Opportunity misses those who view the world through the eyes of their profession or their beliefs.
Let me ask you this. I have a couple questions that I want to ask you about different trends and the impact of the economy, and I'd like to kind of run through them. Obviously, one of the things that people are talking about right now is the millennials, the buying power that they're having. It's growing every single day. The fact that their purchase interests may be slightly different. What are you seeing in terms of the state of millennials, particularly as it relates to real estate? And does their buying interest make a good argument for things like apartment investing, for example, as opposed to single-family houses?
Yeah, of course it does, because they can't afford to buy them. You look at all the numbers. Look at the decline in middle-class status. Look at the lack of wage increase over the last decade. Look how many are living with mommy and daddy in their 30s. And I was a young guy, you got out of the house as soon as you could get out, and you could do it, but you can't do it anymore. So of course they're going into apartments because that's what they can only afford. So there's going to continue to be growth in that. And there's going to be a correction, of course, at some point in real estate. You're seeing it happening around the world. What's going on in Australia, in the major cities like Melbourne and Sydney, 9-12% drops. And as I mentioned, you're seeing it in the United States as well. So you're going to see a pullback, but the prices have to go much lower into the 250,000 levels for them to afford anything, many of them. So it's not the millennials aren't the Xers or the boomers. They don't have the wage earning capacity that we did. And there's another reason for that, by the way, and that's the multinationals that have done away with so many of the entrepreneur businesses because they gobbled up so much. Again, going back to merger and acquisition activity and cheap money. So their job prospects and opportunities aren't great. And then you look at the millennial debt level from getting out of college. I mean, could you imagine getting out? I can't imagine it. 30, depending on whose numbers you're looking at, like $37,000 in debt on average, and you're just beginning your life. So you're going to see a very difficult time. and then getting degrees in worthlessness. That's the other thing.
Certainly.
Oh yeah, that degree in gender studies, history, and that's going to really get you far, man. You know, I got to be proper. I said it's going to get you far, man. I got to say women too. I mean, I don't want to say. I can't say hey man anymore. I can say hey women too. You know, so I mean, everybody's got so tight, you know, about just joking around. They realized also you can't call that place where pilots are anymore a cockpit. You know, can't talk about that either. But
let's talk about technology. I hear people talking about robots and self-driving cars. I want to hear your perspective on that and how that may impact the economy overall in terms of jobs, for example, or let's say the retail sectors in particular.
One of our top trends, either 2016 or 2017, was driverless cliff. This driverless car stuff to us is just a bunch of BS. It's not going to happen. What world are they living in? Where are they driving? If you're going to be driving out in some rural country area, you'll have a driverless car. It's not going to happen for a very, very long time. And when it does happen, it'll just go from point A to point B, not in heavy traffic. Like maybe a bus route or something. But even there's years behind that. We don't see it happening. And we believe that the auto industry has overinvested in technology. And so we don't see that at all. Just like with electric vehicles, you saw what happened when we had all this frigid weather and how electric vehicles lost 70%, 40 to 70% of their range because of the cold. We're talking about a technology that was invented in 1800. And so until they come out with a new technology better than batteries, we're not going to see electric cars. What was the other question you asked me?
Yeah, robots. I mean, there's a lot of talk about... Yeah, go ahead. Yeah,
they're going to take jobs. Of course they are, just like industrialization took jobs away from industry.
Right.
So it's the same setup.
Right, but it created massive economic growth. I mean, that's the whole thing. I think you're dead on there. Like the Industrial Revolution, the advent of the combustible engine may have taken jobs, but it didn't mean everyone was poor. It meant that people could have refrigerators and stuff.
Exactly. So that's what we're saying. You're going to see a decline initially, and then something new will be invented and move into a new direction.
One of the things that pretty much everyone that is a forecaster or non-forecaster is paying attention to is the spread between the 2 and the 10-year Treasury. As of the recording of this right now, we're close to about 18 basis points, and it's pretty close to an inversion. It's been a little bit closer previously. What do you think an inversion would mean right now, especially given how low the interest rates are in the United States as well as globally?
I don't know. It's not something where I would make a forecast on because of the uncertainty around it. And again, when you look at the global levels of what's going on and how cheap money is flowing, we're in a different time period and a different space. So it's not one of the indicators to me. And again, I'm not saying it shouldn't be or I'm right or wrong about it. It's just not one of the ones that has my interest in where things are going to go. But again, I'm not saying that it's not important. It's just that it's not what I see on the screen right now to make the big difference.
Fair enough. And I feel like that's actually an important point. And I'm glad you kind of clarified that, because just because everyone's paying attention doesn't necessarily mean that your particular perspective is worthwhile. It does, especially if everyone's paying attention.
It may be, I'm not saying it's not. By the way, to us, there's what's going to really shake these markets and that people should be concerned about, but nobody's talking about, is war. And now there's one heating up in Venezuela, and there's one heating up with Iran. If oil prices, we're talking about the world's largest oil reserves with Venezuela, and Iran right up there is one of the world's largest producers that now they're also making them broke as well with the sanctions. If war breaks out in the Middle East, and with the destabilization with the Saudi government, with the prince and with all that's going on with the destabilization there, Yemen, and if oil prices hit $100 a barrel, we're saying there's not only going to be an equity market crash, but a global economic crash. And I want to put the whole thing back into perspective again. We were talking earlier about the dollar and where things are going. And I mentioned how strong the dollar was when the Fed was raising rates. So although the Fed is lowering rates now, the dollar is still relatively strong because other countries now are also lowering their interest rates. So I mentioned India before. Last year the Indian rupee hit an all-time low, and now they're lowering interest rates again. That's going to put downward pressure on them. So let's go back to oil. India imports 80% of their energy. What is oil-based? Petrodollars. Their currency is weakening. What do they have to buy the oil with? More of their weakening currency. So what does that do to their economy? It brings it down even lower, and you could go around the world. China, world's biggest energy importer, one after another. So the geopolitical issues we look at, and by the way, our process of tracking trends is called globalnomic. I mentioned that opportunity misses those who view the world through the eyes of their profession. Well, if you're only looking at economics and not geopolitics, or social change, or environment, or aging, on and on, food. We look at over 300 different trend categories, energy. So putting the perspective back again, if there is war breaking out, and no one's talking about this, you're going to see oil prices hit $100 a barrel. And by the way, that's what Saudi Arabia needs it at for its economy, its budget to break even. A couple of years ago, and they're still doing it, they're issuing bonds. They were never issuing bonds before. They have major problems going on there. So these are the kind of things to look at. And I mentioned that nobody's talking about it. Do you know that I mentioned the presidential reality show? Only one Democratic candidate, the woman from Hawaii, has commented on what's going on in Venezuela. None of the other ones have. The whole midterm elections, the entire midterm elections, we wrote about this in detail in the Trends Journal. And again, there's no advertisement in the Trends Journal. So we say what we say to say it because this is where the trend is going, this is where the facts are, and this is where we see it going. Not one mention of any of the candidates in either the Republican or Democratic Party during the midterm elections of the wars going on and what the implications would be. So those are the kind of things that we suggest people should tune in more to, because you're not going to get it by tuning into the major news. And when they do tune into it, it's basically propaganda. They follow the government line, been doing it. As I mentioned to you, that's how I got in the business. I watched everybody learn to hate Iran without knowing the history of it. And when everybody was going in one direction, I jumped in the other. I said, this thing's going down, man, and the implications are going to be tremendous. And that's what happened. So we're suggesting people let go of your ideology, look at the facts, and watch closely what's going on. And that's why, as we say with the Trends Journal, it's the only magazine where you'll read history before it happens. We're the only ones reporting on this in so many different levels, at so many different depth levels as well. I want to make clear we hope there's no death levels going up, because that won't help anybody.
Yeah. Well, that's actually, I appreciate you sharing that. That was going to be my closing question, was to what you're keeping an eye on. And that's actually a really good answer. And man, it is scary to think about, especially what was happening back then. Learn to hate Iran. That is, man, I'm going to have to sit and think about that one. So, all right. Well, you know what? I know our time is coming up and I want to respect your time. So before we jump off though, Gerald, I want you to give the opportunity, if people are interested in getting out of the weeds of the mainstream media, learning about some of the trends you follow, how can they learn more about your letter and how you can learn more about your firm?
Well, the magazine is the Trends Journal, and it's a monthly. When I started, it was a quarterly, and last year we made it a monthly. We put out trend alerts each week. New one's going out just now, and we're mostly on the economic sectors. And we also do broadcasts Monday through Thursday, but now we're going to be going into a whole new realm that's coming out next week, a whole different podcast level. And again, it's the only magazine where you're going to see tomorrow's trends today, money back guarantee. It's only $129 a year. And if you don't like it, that's not what we say it is, we give you back your money. You have nothing to lose. But I have to tell you, I've been in this business now, next year will be 40 years. And I've never seen such a wild ride into the future as the one we're on now. So if people want to prepare, prevail, and prosper, I suggest they consider the Trends Journal.
Awesome. So we will link to that in the show notes page. Gerald, I can't thank you enough. Really an honor to talk to you, and thanks again.
And thank you for all that you do.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.